Now to the fallout from the Fed's latest interest rate hike, raising the cost of borrowing to cool inflation. Morgan Norwood explains what this means for you, especially if you're looking to buy a home.
Millions of Americans now wading through another round of economic pain as the Fed once again hiking interest rates by another 3/4 of a point for the third time since June, all in efforts to fight the historic inflation.
We have got to get inflation behind us. I wish there were a painless way to do that. There isn't.
This means home loans are more expensive. The average 30-year fixed mortgage rate nearly doubling since January, now above 6%. And here's the breakdown on this. 1 month ago, to buy the average $440,000 home, you would have needed to make monthly payments of about $2,000. Today, that same house will cost you $2,200 per month.
The housing market doesn't do well in a rising interest rate environment. And that's because consumers are relying on mortgages in order to become a homeowner. And what we've seen since the start of this year is that millions of Americans have now been priced out of homeownership.
Which in turn means many of those potential buyers are now forced to rent. But rental rates, along with the cost of groceries and gas, have also skyrocketed, up 6.7% from this time last year, outpacing wages.
If nothing comes up or there's nothing that sort of is affordable, then I will just wait.
But the news isn't all bad. A new Redfin report shows the housing market is actually cooling off, happening from coast to coast.
Buyers are able to go in now and not have to pay $100,000 or $200,000 over list price, and they're able to negotiate all their traditional contingencies.
And the big question is whether this decision from the Fed is signaling a coming recession. And look, more economists say that's likely. But the bottom line in the consensus opinion here is that still, even if there is a recession, it'll be a short and shallow one. I'm Morgan Norwood, ABC News, Los Angeles.